Up first is Dave Paterson to provide the overarching view and examine some key economic factors that are currently top of mind. Dave Paterson is responsible for the management of Empire Life multi-strategy gifts. Prior to joining Empire Life Investments, Dave was Director, Public Markets, Research and Analytics at a registered portfolio management firm, where he was responsible for the sourcing, evaluation, and ongoing monitoring of investment products. Since 1994, Dave has specialized in investment fund research and performing ongoing analysis on thousands of mutual funds. Dave has a Bachelor of Commerce from the University of Windsor and is a CFA charter holder. I'd like to introduce Dave Paterson. Thanks, Dave.
Thank you, Mark, and thanks everyone for taking time out of your busy out of your busy schedules today to listen in. Very happy to be part of this call, and very happy to be talking to you about the independent series. As noted, what these really are is, if you're not familiar, I'll keep it real simple. Is 5 model portfolios, really targeted for different risk tolerances, ranging from your very conservative to your more aggressive. And I'll just really touch on these. Moving your practice to a very model-based business is very helpful, because first and foremost, it helps you be a lot more efficient, a lot more scalable, and that can result in a much better experience for your client. You have the confidence in knowing that the portfolios are put together using a process that is very, very focused on risk management. And that, to me, are really the key benefits. And one of the things is these portfolios are really kind of positioned as, similar to a separately managed account, like you would see with a lot of the IROC type dealers. And to some extent that's true, but there are a couple distinctions. And first is that, while I am a portfolio manager for these portfolios, I'm a portfolio consultant. And this really, I think, is an important distinction, because as the portfolio consultant, I do not provide advice. So I can't speak to you or your client and tell you what's best. I cannot make transaction in the client's accounts, and nor do I make any tactical or discretionary trades. But what I do is I build and I create, I maintain, and I monitor these model portfolios. And that involves the building of them. So that goes out sourcing all of the various individual strategies that are in the portfolios. Then we put them together in a way that makes sense. And we'll walk through that process in a little bit more detail. And then where necessary, we would suggest any changes to be made within the portfolios. So as I mentioned earlier, the independent series are really 5 portfolios, ranging from conservative, which runs at an asset mix of about 70% fixed income and cash, 30% equities. We have our balanced portfolio, which is that traditional sort of 60-40 portfolio, 60% equities and 40% fixed income and cash. And then at the very high end, we have a high growth portfolio, which is pretty much all equity except for a very, very small cash holding. So taking a look at what the portfolios look like, each essentially is made up of the same basic building blocks. And when I went putting these portfolios together, it was really about going out and finding a really good mix of good, high quality funds that were really complementary to each other, and with the objective really of providing a really well diversified portfolio for your investors. And if you take a look at the portfolios here, you can see we've got a very small cash balance. Then we have short-term bonds in the very conservative portfolio and moderate balance. And this really plays the role of that defensive piece. It takes a lot of the volatility, acts as a great buffer in periods of extreme market volatility. Then we have a couple of different fixed income options. Beutel Goodman Income is very much that core strategy, and that's essentially designed to give you that, essentially that Canadian bond market experience. It really focuses on a blend of government bonds and investment grade corporate bonds. The next step down is we have the Beutel Goodman Core Plus Bond Fund, and this really builds on that core strategy, but it brings in a little bit more in terms of high yield. It'll bring in some asset backed, it'll bring in some mortgages, it'll bring in some of those non-traditional or slightly more, I hate to use the term risky, but you can generate a little bit of a higher yield, higher return, and with professional management, it can certainly help generate some different return streams. Then we have Franklin Clearbridge Canadian Equity, which is really a core product with kind of a growth at a reasonable price type of an approach. Then we, for our U.S. equity exposure, we're using Butel Goodman for their American equity strategy, and it's very much a value tilted portfolio. And then our global pieces, we have the Canoe Global Equity Fund, and we're going to learn a lot more about that later on, which I really like, which is a really high conviction, high quality, growth tilted portfolio with a very well resourced and a very disciplined process and a great team behind it. Then we have the Capital Group Global Equity Fund, and what I really like about this is it's much more diversified than the Canoe Global Equity strategy. And they achieve this diversification in a couple of different ways. First is that they have a larger number of holdings than the Canoe product, but they also have several different managers. The capital system is really interesting, and now they'll bring in 4 or 5 different managers who have different but yet complementary styles, put them all together under the oversight of one portfolio manager, so you really get an all-encompassing strategy. So when you look at how each of these is designed to, each of these funds performs on their own as well as together, you get a really nice blend and a really nice mix to the overall portfolio. And when I think about how you build a portfolio, it's not so much about going out and finding the best funds. It's more about going out and finding a good mix of good, high quality, well managed funds that are put together in a way that can, at the end of the day, it's better than the sum of its individual parts. And usually what I mean by that is that it provides better or comparable returns, but does so with less risk and less volatility. And that's important, because if you can provide a smoother ride for your investors, they're more likely to stay with the program. The other thing that I really like about having a really well diversified portfolio is it's going to hopefully reduce your drawdowns, which means it's much easier to recover. So what I mean by that is, if you've ever looked at the math of losing, so if you lose 10%, you need to generate a return of 11.1 just to break even. If you drop 25%, you need to earn 33 1/3 just to get out of that hole. So the lower that drawdown can be, or the less the less loss that we could experience, the better off the client will be over the long term. And that's really the focus of what I'm trying to do. So in terms of how I go about putting these portfolios together, it really starts with a quantitative screen. And what I'm trying to do here is weed out the funds that are too expensive, that don't deliver anything of value over and above what we can get from the basic index product. And then from there, that leaves me a much more focused list that we can go do a qualitative review. And when we do the qualitative review, really what I'm trying to do is understand who manages the portfolio and how they manage that portfolio. Because when I've run my quant screen, I have a list of funds that look attractive from a return and a risk perspective, but I don't know how those returns were achieved. When we move to the qualitative piece, I begin to understand how those returns were generated. And once we understand how those returns are generated, we can then make a decision or make a call on whether or not we believe that that return stream is something that's repeatable on a go-forward basis. And if it is, then we can take it to the next stage, which is the portfolio construction phase. And here, what we're looking to do is really to try to find that mix, to find that balance between the risk we're willing to accept and the return that we're able to achieve. And what I'm trying to do here is to make sure that we are very well compensated for every unit of risk that we assume. So I don't want to take risk for the sake of taking risk, but I also don't want to avoid risk if we're going to be well compensated for that. And I want to find that nice balance, because that over the long term should be able to give us that nice, smoother return stream for the end investors. And then the last piece is this ongoing management, where really every month we go in and we take a look at the portfolio as a whole. So how did it do on its own? And then we go in and we do a deep dive on each of the individual pieces and understand why the return was the way that it was. So the first step in this is I'll run a screen on the Canadian investment universe. So when I'm looking for any new fund, that's the first thing I want to do. And I'm screening on a number of different risk reward metrics. I could talk for hours on each of these, but I will spare you the that experience. But these are the factors that I generally screen on, and this is a very effective way to narrow the universe. So I follow about 3,500 Canadian mutual funds, and by the time I put that universe through the screen, I'm left with about 400 to maybe 500 that are worth taking a look at. And then from there, we go do that more qualitative piece, which is really about, as I said, it's understanding who's managing it and how. So the first thing that I'm going to look at is who is the manager. I want to understand who they are. I want to understand their experience. I want to understand their past track record. Then I want to understand who else is on their team. And then how does that team work? How is that team structured? How does that all fit together? You want to make sure that the team is adequate for the mandate that they're running. You want to make sure that there's enough people there. You want to make sure that there's enough coverage. And then you want to make sure that any experience or any track record that they're quoting is applicable to the strategy that you are reviewing. So, for example, looking at a Canadian equity manager who's only run emerging markets, that's really kind of pointless. So you want to make sure that the experience that they have is in the mandate that you're looking for. The next step is to understand that investment process. So how do they find their securities? How do they find what they want to invest in? I want to understand that how their screening process. I want to understand how they review these underlying securities. I want to understand how they make their decision to buy or to add a name to a portfolio. I also want to understand how they decide to remove a name from the portfolio. Another thing that I really like to understand is what their philosophy is. So like, how do they view investing, and what kind of an investor do they think that they are? Are they a value investor? Are they a growth investor, growth at a reasonable price, momentum? And there's no right answer here. And really it's all about understanding and looking for consistency. Because, for example, if they tell me that they're a value manager and yet they hold, Tesla or Nvidia, well, clearly you're not value based on any practical measure. So I'm always looking for consistency, because it's rare that you're going to find, a screaming red flag on a particular strategy. So instead, you have to make sure that everything that you're being told is consistent with everything that they do, and then that the returns and risks that you see are consistent with everything that you're being told. Another thing that I always like to look at is the overall risk management. So what kind of levels of oversight are built into it, position sizing, constraints, all of that. And then that helps me to understand whether or not it is likely that the return stream is something that is likely to be repeated on a go-forward basis. Once we implement the portfolios, as I mentioned, we review these monthly. And we will go through. The first thing that I'll do is I'll look at the returns relative to benchmark, relative to the category average. And then I will look at what drove that return. So what were the underlying strategies that underperformed? What were the underlying strategies that outperformed? And then drill deeper within those to understand what happened there. What I'm looking for at this level is I'm looking for any kind of an erosion in the process, any kind of a change to how they do what they do, any kind of a change to the team that is overseeing things. If there are, then that raises concerns that causes us to drill deeper. Also, if we notice something that's a little out of character, we will drill deeper, and we'll go in and we'll reach out to the management team and try to understand what's happening in the portfolio. And then from there, assess whether that's something that's a little bit more temporary in nature, or if it's something that is more of a longer term issue that may impact the ability of this fund or this strategy to stay within the portfolio. And then, inevitably, why would we want to change a portfolio? And quite honestly, in a perfect world, we would never have to change a portfolio. And fortunately, since these portfolios were launched back in 2020, we have not had to make any changes. And a lot of that is because we do a lot of work on the front end, trying to make sure that we pick good managers, good teams with good processes. And if we do that, hopefully we won't have to make changes. But there are times when we need to. The first one, obviously, is a rebalancing, and these portfolios are rebalanced for you regularly. I believe it's on a semi-annual frequency, but there's other reasons. So if there was a change in the mandate, so for example, if There was an international equity fund that we really liked, but they decided that they wanted to incorporate US stocks, making that into a global equity fund. That would impact how that fund would be expected to perform. That would bring up concerns and questions around the management team running it, as well as their process. There's a lot of moving parts there. We'd want to make sure that we fully understood what that was and how that would impact the overall portfolio. Another reason that we would consider making a change would be if there was a change in the management team of the fund, because again, how the process is implemented or how the fund is managed is definitely going to impact how that would perform on a go-forward basis. Changes to the investment process or selection criteria, or in some cases, we just may find that we can access a very similar fund for a significant cost savings in some cases, or we'll find something that may be a better fit. So those are the reasons that we would change. But typically we try to limit the changes. It just reduces the overall level of complexity. So turning now to the performance, 2024 was an okay year for the strategies. We looked fairly good relative to the peer groups. We trailed our benchmarks, and the reason for underperforming the benchmark, quite honestly, is there's a good chunk of, on the equity side with the global equity portfolio, there's about 70% of that global equity index is in the US equities, and there's a very high level of exposure to the Mag 7 stocks, so a lot of those AI driven type mega cap tech names that have driven a lot of the return. So these portfolios by design are going to be underweight that. So it will be hard to keep up with your overall benchmark, but we still look very good relative to the peer group. And if you go out and you take a look at our inception numbers, again, we're very competitive with the various category averages, which would be applicable for our peer groups. And we've delivered returns over and above that on both an absolute and a risk-adjusted basis. So I thought now we could spend a few minutes kind of highlighting, kind of where we are and where we're going. I'm not going to spend a lot of time on Q4 because it's February and everything that's already happened. It's well ahead or well behind. But again, looking real quickly at returns. So for 2024. U.S. equities led the way, up around 37%, 36.4% in Canadian dollar terms. Canadian equities were next, up about 21.7%. Japan had a strong year in Canadian dollar terms, up 18.5%. And international stocks trailed again, up about 13.8%. Now, looking over at fixed income, returns were kind of mixed. International bonds, so non-U.S. or non-North American bonds, really trailed. They were down about 4.2%. Canadian credit, corporate bonds were the strongest performers, up just under 7% on the year. Canadian core bonds were up about 4.2%, and long bonds in U.S. core up around 1.3%. So earlier, when speaking about why the portfolios trailed the benchmark, I'd mentioned about market concentration, and this is something that is a little bit of a concern to a lot of people. And this chart really shows the exposure of the top 5 companies, top 5 largest companies in the S&P 500 as their weight. And you go back to pre-2018, and the top 5 names were running around sort of averaging 10 to 14%, or 12 to 14%. But over the last several years, in the COVID era. That level of concentration reached levels that we haven't seen in quite some time. And it's, very, very close to about 29% made up of the top 5 names. And this can be problematic because so much of the index return is driven by such a small handful of names. And we see it every time NVIDIA, if NVIDIA misses numbers, the entire market sells off, and NVIDIA is responsible for such a large portion of that. And for most managers, it is very risky and not necessarily a wise decision for them to have carry those types of names at market weight. So you're generally going to be underweight in those types of periods. But we are watching this, and this will correct itself. The question is how it corrects itself. There's 2 ways. One would be that the five largest names have a period of underperformance where they lag for quite some time. The other way that it can correct would be if we were to see a fairly meaningful sell-off. Not quite sure how it's going to play out, but we're trying our best to make sure that we have the managers in place that can help provide the resiliency regardless of how that plays out. Turning a little bit more to the economic outlook and scenario, inflation has been really on top of mind since sort of like 2022, where it really spiked, reaching more than 8% in Canada. And central banks have been very aggressive in their fight since mid-22, trying to bring inflation back down to that 2% level. And in Canada, we are almost there. At our core, we are at 2.1%, so slightly above the 2% target, and our headline number is 1.8, down significantly from that peak. And this is pretty much in line with what we're seeing globally, where, again, inflation, both in the US, which is the blue line, and the orange line, which is the Eurozone, peaked and are now very close to that 2% target. Now, this getting from where we are to that 2% target is going to be challenging, especially with the threat of the ongoing continuing threat of tariffs, which may or may not ever materialize. But that's going to keep inflation or keep upward pressure on inflation, which is going to make it very difficult to reach that 2% level, which may also result in rates staying a little bit higher than we would like. If we look at our core inflation, which backs out the very volatile food and energy component, Canada is really the only one very close to that 2% level. US and Europe are approaching it, but we're still a ways away, which means there's more central bank action potentially, depending on how things kind of play out. But turning to central banks, what this chart shows is there's a function in Bloomberg which goes in and it looks at the various bond yields, and it gives us an idea of what the market expects to happen in terms of central bank cuts. And excuse me. And this shows that the green line is the Eurozone, the dark blue is the US, the lighter blue is Canada. So, over the course of 2024, markets are expecting that the Bank of Canada will cut twice. Federal Reserve will cut one more time, maybe twice, and the Eurozone Bank will cut about 3 times. And this will see the overnight rates drop a little bit from current levels. Bond yields, they're higher than they've been in quite some time, which is great from a portfolio management perspective, because now you can actually generate some level of return from your fixed income sleeve. Also, too, with the higher yield from the bonds, in the event that we do hit a period of equity market volatility, with the central banks likely more likely to cut than to raise, that will allow bonds to be that portfolio buffer, and as they have historically been, allowing the value of the bonds to mitigate some of the losses and some of the volatility out of the equity markets. We didn't see that happen in 2022 because central banks were really focused on trying to fight inflation. There was continually upward pressure on rates, which did not allow the bonds to really act as that buffer through that period. Another thing that I track a lot fairly closely is trying to understand what the markets believe the likelihood of a recession is for, or what the likelihood of a recession is. And I can look this up, and really the risks are fairly low. Markets predicting the potential, about a 30% probability that we'll see a recession in Canada or the Eurozone in the next 12 months, and about a 20% chance in the US. And that's, a little bit higher than normal, but certainly not at the ranges or levels where I would get overly concerned about it. Flipping now to the leading economic indicators, and what these are is a basket of economic statistics that have historically been shown to lead an economic recovery. And what this shows is that the economic indicators are improving, but Canada right now is the only country of these three here where the leading economic indicators are positive and growing. In the US and the Eurozone, they are getting less bad. but they're still in negative. So this is all somewhat encouraging. Consumer confidence. This is the U.S. University of Michigan Consumer Confidence Index, and this does not reflect the results that came out. I think it was last week or earlier this week, which showed the consumer confidence was again a little bit lower. Because this is important because so much of the U.S. economy is really driven by consumer spending. So you want to understand what kind of a mood that they're in. They're getting a little nervous. So this is something to keep an eye on for the consumer focused areas of the U.S. economy. But again, it really comes down to jobs, right? In the U.S., it's really key to look at unemployment, as well as in Canada. Jobs are very important. If people have jobs, people will spend money, and we can see that unemployment peaked a couple of years ago and has been on an upward climb. But we're still not at levels that are we're still at fairly low levels of unemployment, which is generally very positive. People are generally working. People generally have jobs, so that bodes well near term. So, overall, there's a few areas of concern, and obviously, with President Trump in the White House and the possibility of tariffs and a trade war, that's going to be a little bit of an overhang, and that can certainly weigh on things, but I don't think that we need to be panicking at this point. So looking ahead and how I kind of see the world is, with Trump in the White House, it certainly does bring a level of unpredictability to the markets. And we are pretty much at the mercy of the man and his Twitter account. And the things that he says, which may or may not be valid, which may or may not come to fruition, but they do have the ability to move markets. Latest example, steel tariffs, 25% across the board, supposedly starting in early March. We'll see what happens. He's been talking about wanting to take over Canada. He wants Greenland. He's renamed the Gulf of Mexico to the Gulf of America. But at the same time, we're starting to see upward pressure on inflation. So we'll see how these all play out over time. And really, too, you have to think a lot of the policies and a lot of what he talked about getting into office was really very pro-business and pro-growth. And I think that if he continues to follow those paths, that'll be positive. However, given the unpredictability of the tariffs and the trade wars and the taking over the world, there's a lot of unpredictability that really could offset the benefits of the pro-business. So you kind of have to take a wait and see. You can't try to get too cute from your positioning because you don't know what's going to happen. So you focus on good quality managers, good disciplined processes, and ideally building out very strong, very resilient portfolios. We look at where we are, and there are a wide range of outcomes that are possible. We could see a recession, probably in Canada, depending on the impact of tariffs. Definitely the U.S., maybe not. However, we could see stagflation as well, where the tariffs put upward pressure on prices, but slow growth, which would be a very tough market environment for everybody. We could still see a soft landing. Who knows? When I look at our underlying management teams, they all remain focused on doing what they were hired to do. They're all focusing on finding good, high quality companies. All are focusing on finding those companies that have a demonstrated history of delivering strong cash flow generation. They continue to manage their portfolios consistent with their processes. So there's no concerns with any of our managers right now. And yeah, there's a lot of wild cards out here. We've got rising geopolitical tensions. We've got that trying to get inflation down to that 2% level. And of course, we have the Trump factor. But, I'm very positive around these portfolios because we have great management teams in place, and they continue to do what we hired them to do. And they continue to perform and deliver returns that are very much in line with the expectations that we have when we look to building these portfolios. And as a result, I see no reason to make any material changes to any of our underlying management teams or the portfolios as a whole. So with that, I'm very happy to pass it along to Guillaume, and he can give us or pass back to Mark, who will introduce Guillaume, and he can give us a much more detailed overview on PineStone, their approach, their process, and hopefully after he's done that, you can understand why I am such a fan of what they do and how they do it. So back to you, Mark.
Thanks very much, Dave. That was very insightful through the indicators and how you manage the process. Next, as Dave said, we're going to drop down a level and drill into a specific investment philosophy, including taking a look at security selection. In this section, we're going to hear from Guillaume Bougie, who is going to bring a wealth of expertise to this role, as he's an investment specialist within PineStone's institutional client relations group. Prior to joining PineStone, Guillaume was an institutional portfolio manager at Desjardins Global Asset Management and also at Jarislowsky Fraser, both names I think that everybody would know, where he helped both firms manage their institutional client base. Prior to that, Guillaume spent close to 20 years working in the equities department at different investment banks, including Goldman Sachs in New York, TD Securities in Toronto, and leading the office at Credit Suisse in Montreal. So he's got lots of experience around different parts of North America. So I'd like to introduce and welcome Guillaume to the presentation. Thank you, Guillaume.
Thank you, Mark, and thank you, Dave. And I think I don't know what else I can add. I mean, this was a great entry point into where we stand currently in the market. But let me talk to you a little bit more about the firm, about the Canoe Global, about how we select securities, and you will see how that fit with everything that Dave was talking about in terms of long-term and security selection, and the focus of PineStone. And again, this is your time, so at any point in time, if you'd like to interrupt, if you have questions, feel free to go ahead and ring the questions. I think, Mark, you can interrupt me anytime you want for any Q&A. Hopefully you see the presentations currently. If you don't, someone can voice it so I know to restart it. But PineStone Asset Management was founded in 2021, but the story of PineStone started really in the early 2000s, and that's when Nadim Risk and Andrew Chan and Dominic and Thomas, really 5 or 6 people came together and started the global equity business at Fiera Capital. And they grew that business from 0 to $60 billion from the early 2000s to 2021. And in 2021, Nadim and the team really wanted to become their standalone, their company, and to, if you want, spin out of Fiera. And they did that in a very amicable way. But so the firm started in 2021, but the funds, the track record, the philosophy, the team, they've been together for 20 years now with the same single philosophy, which is to invest in quality, kind of long-term investments in public markets. So at this point, we are now an investment boutique. We are proudly Canadian. We like to say it these days. I think it's important, but we're based here out of Canada, out of Montreal. We are 100% employee-owned, private firm, and we are now up to close to 80 billion of AUM. We manage that for clients in the US, in Europe, in Asia, and in Canada as well. So it is really, truly a global success story. The investment team is now up to 12 members. We've never lost a member of the investment team. We've added throughout the year, but everyone's always stayed together. And, the one thing that we do and why we created this investment boutique is we do one thing and one thing alone, and that's investing in global equities. We do break it down into different pieces. You can buy it as a standalone global fund, like the Canoe Global Equity Fund, or you can, we offer it at some of our clients to do it US and international, and then you can do the asset mix yourself. Now, what makes PineStone very, very different than other money managers that you'll see on the street? Number one, because we are employee owned, because we are highly invested in our strategies, in the same strategy you are invested in, and because we are compensated on portfolio performance above the benchmark index of the one product, global equity, that we have, we are 100% aligned with you. So if our clients make money, we make money. If our clients are happy, we are happy. And that alignment is something that we fought hard for, and that's why we created the firm. Number two is our research team and our research group and our research process. It is very rigorous, it is structured, it has been built over 15 years, but at the base of it, it's people, it's our research analyst, and the fact that at PineStone, a research analyst is a job and it's a career and it's something that we reward and we value highly. Other money managers, the research analyst job, they will move people around and it will be a stepping stone for something else to do, or another portfolio manager role or something else. For us, we're proud that Jua, for example, has been following technology for 18 years with us, and that he's followed Taiwan Semiconductor from the inception date in the portfolio to today. We highly valued that research, and for us, the research analyst is really a career, and that's part of like our philosophy of investment. And finally, it's our mindset and it's our time edge. And what we are trying to go after in equity market, the inefficiency that we're looking at going after in the market is what we call our time edge. And it's our view that investors, human beings, are not, don't value properly long-term benefits, long-term compounding. Anything that's 10, 15 years in the future, saving money for retirement, preparing for, the aging of the population, global warming. You see it time and time again. Every time we say, it's going to be really bad or really good in 20 years, we tend to really not pay attention to it as much as we should. We discount the value of that. And in equities market, what we see time and time again is that these highly profitable companies that have the ability to compound return on invested capital at a very high pace for a long period of time, because they have a business model, and we'll go through ideas and in the portfolio that are built to sustain that profitability over a long period of time, that have good growth, but not spectacular growth. We want them to keep growing, but just to really keep compounding profits over a very, very long time. They're being often undervalued compared to the cool, shiny toy that's in the market currently that everyone wants to have. But the truth is, the power of compounding, and we're all financial people in finance here. We know the math. I was actually explaining the power of compounding to my 16-year-old daughter yesterday for math exam, but it is exponential. It is not linear. When you compound 30% ROIC, return on invested capital, on 30%, on 30%, on 30% for 1 to 2 years, yeah, it's interesting. But if you do it for 15 years, that's when you have that exponential curve coming along. And that's the real power of compounding. And that's really what we're after. That's the inefficiency that we go after in the market. So what is a high quality company? And I think that's, it's going to taint what we talk about later on, because I think every manager out there really always talks about investing in high quality companies. For us, it really starts on return on invested capital. It is a metric of profitability of every dollar that went into building a company. So if a company uses a lot of debt, it can look very profitable. As you know, that's using leverage. Leverage goes both ways. It can be really good or it can be really bad. But when you look at return on invested capital, all invested capital, including debt, then all of a sudden it gives you a true measure of the profitability of a company. And then after that, we look at that ROIC. It's easy to screen for high return on invested capital every year. But for us, for the power of compounding, that company must be able to protect that return for 10, 15 years. They have to have very high cash flow. They have to have very little debt. They have to have great management that can be able to redeploy that capital and not waste it in bad acquisition. And at the end of the day, if you do all of that, if you have highly profitable, low leverage company with spectacular business model that can protect that profitability, it's going to preserve capital as well. Because preserving capital is number one for us, as it is for I'm sure all of you and all of your clients, Dave was talking about the math of up 10 and down 10. We believe in that too. And again, our money is invested in the funds. And so we're going to be there till the end. And so preserving capital is very, very important for us. And we think investing in these quality long-term companies will get you that growth with great protection. This slide here sometimes surprises and shocks many because it's public equities. So you expect that because it's public equities, one should be trading. Because there's liquidity, one should be using liquidity. And we think that's the mistake that most investors do. Because it is there, it is not there necessarily to transact companies. For us, liquidity is very attractive for your clients, to be able to redeploy capital for your clients, to be able to buy another house or buy a boat, or to just rotate capital into fixed income or to do asset mix. That's why liquidity is very attractive in public markets. But to just trade companies to trade companies, we think is a mistake. So as you'll see here, over 40% of the companies in the fund, we've held them for at least 15 years. That is not 3, not 5, not 10, 15 years, 40% of the companies. And then a further 30 have been in there for over 10 years. So if you combine both, that means 70% of the portfolio has been there for over 10 years. And why that is so important and so different is that this is how you see the power of compounding. We think that if you buy a security and you sell a security within 1 to 3 years, you can do the best work on the previous slide of identifying the best management and the great balance sheet and the profitable company. It doesn't matter. The value created or lost will be depending on the multiple you purchased or you sold the securities. If you bought it at 22 times earnings, for example, and you sold it at 18 times earnings over 2 years, you've lost money. There's no way that the company's quality and profitable attributes was able to offset the multiple compression. But if you hold a company 15 years, well, then it's the complete opposite. We don't even remember what we bought Taiwan Semiconductor at in terms of multiple in the early 2000s. And it will be quite irrelevant what multiple we traded out when we sell it, in I don't know how many years from now. The value creation will have been from the company growing and compounding capital and profits. And so multiple, we feel, is very hard to gauge what's expensive, what's cheap. That's very emotional. But cash, profits, accumulating inside of a company, like you've seen with Taiwan Semiconductor, like you've seen with an Apple, like you've seen with many. We've never owned Apple, but that's a great example that people often think of. Like the growth is the growth of the company. Like you've seen it with Microsoft, like you've seen it with Google. It's not multiple growth, it's really profit growth. And that's what we're after. Here is the Canoe Global Equity Fund in numbers. Return on invested capital last year was 18.8%, and the MSCI World was 10.8%. So we're compounding close to double the index. And that is not a manufactured number. As you saw, 60% of the companies have been there for over a decade. We didn't just buy at the end of the year the high return on invested capital companies to just look good. This is literally what the portfolio did last year in terms of our companies. They are compounding capital at a very, very good clip. Revenue growth is here at about 5.8%. These aren't NVIDIA numbers, but we need these companies to be able to take the money and redeploy it in their business. So they're growing well. Operating margins about double the index as well. And what it means is, as you can see, the cumulative gross return since inception is significantly higher than the MSCI World. But to us, this is pure math. If you keep compounding double the index, and you can have companies that have margins double the index, and you let them keep compounding, over compounding exponentially for 10, 15 years, you will outperform. The only thing that can get you out of that outperformance is if that return on invested capital is being challenged. And so all of the work that we do in research is finding these companies for which they can have outsized returns, but business models that protects it from external forces. Because as soon as a company makes a ton of money, competitors, suppliers, all the Porter 5 forces are going to go at it to try to take that capital out, because they won't let a company just have outsized return forever, unless you find those jewels like Alphabet, like Taiwan Semiconductor, like Microsoft, like an AutoZone, for example, that supplies the car parts for all the garages in North America. So when you have an accident with your car, you get to the garage picks up the phone and calls someone to come and drop in the parts. That's AutoZone. And they have a quasi-monopoly. Amazon can't replicate what they do because there's so many car parts. If you just think of a Honda Accord, all the different models, all the different parts over the last 20 years, to keep all these what we call SKUs in the back store, it's a model that's not replicable, but AutoZone has it. They have a quasi-monopoly, so they can keep having this massive return on invested capital, and no one can go after it. So these are the example of companies that we have. We're talking about often duopolies in the market, like Moody's. It's Moody's or S&P, or it's MasterCard or Visa. Louis Vuitton, spectacular brands that can't be replicated. You can't restart a luxury brand with 150 years of history like Louis Vuitton. So if Louis Vuitton's been able to be highly profitable for 150 years, chances are they'll continue to be very profitable for the next 15 to 20. Or TJ Maxx with Winners, which offers those discounted brands in a store like Winners or Marshalls, or they've built that business model now. The Nikes of this world, the big brands, they only want to deal with one company. It's TJX, to offload all their excess inventory. And so TJX does it. They can take it in volume. They can put it across different brands. Then they're now the de facto one player that takes those excess inventory and resells it in the market. Or IGH in hotels. So that's a little bit the types of companies that we have. I can go into a little bit more details in terms of the portfolio, what it did last year. Just to stop for time, Mark, is there any questions? I can't see it on my computer here, but do you want me to continue, or is there a few questions that lined up and you'd like to ask?
I think continuing at this point, I think people are finding this useful, drilling down to the securities level for sure.
Perfect. And so this is, the top contributors for 2024 in the fund. You can get a sense of what we own. So Taiwan Semiconductor, highly popular these days because of artificial intelligence, because they make the chips for NVIDIA. But really, we've owned Taiwan Semiconductor for 20 years because we thought semiconductors would become a bigger and bigger part of our lives. And Taiwan Semi is the #1 manufacturer of chips. So the way to think about it, you have companies like NVIDIA, they design a semiconductor, but they do not make it. So they give it to a manufacturer. And at this point, at the high end, it's Taiwan Semi. Taiwan Semi used to have other competitors like Intel and Samsung, but both companies are really struggling with the high-end level of chips. And so Taiwan Semi, that was the dominant player 20 years ago, is now even more dominant today. And really, they make chips now for Intel, for Broadcom. They make it for Google. They have their own chips. They make it for Apple. They have their own chips. They make it for Tesla. They want to put their own chips in cars. They make chips for everybody, make semiconductors for everybody. So for us, it's a way, it's a spectacular company. The return on invested capital is magnificent. And because they're not leveraged to one end market, it has to be AI, or it has to be cryptocurrency, or it has to be iPhones, or it has to be PC computers. If they make it for everybody, so as long as you have more semiconductor, they're going to keep making it. And that's a technology company that we can bank on having highly profitable business for another 5 to 10 years, easy. And we love that. We can sleep at night, no matter what happens, TSMC will keep making semiconductors. Same for Alphabet and Google. Great year last year, highly profitable. The AI craze as well. I mean, Gemini, Alphabet is in the middle of all of this. But for us, they own the relationship with retail, through Gmails, through, Google Flight, through, everything Google has. They know everything about people. And as AI becomes more and more prevalent, AI needs data to have applications that will be useful to us. Well, who has the data on us? Well, Google has the data on us. So we feel like Alphabet, with their search business, with the investment in AI, with all the developments with AI, is extremely well positioned. It's massively profitable. So that's a company that will keep owning in the portfolio for the next. And if there's a sell-off in AI, you know what? If AI doesn't hold all the promises that we think it should hold, Google is still going to make a lot of money. This is not going away anytime soon. There's really no one to challenge them in searches. MasterCard has the best business for digitalizing payments. We often think of MasterCard as the credit card, but really the MasterCard that's very interesting is the back end, the systems to make transactions online. That's really is the big business for MasterCard. And we've all moved away from cash and checks to paying digitally for everything. But there's still lots of areas in the world where they still pay with cash and checks and hard currencies. And MasterCard is displacing that, and they're continuing to execute, especially in the emerging markets now. There's a lot of, as soon as money moves from hard currency to digital payment, MasterCard is the back end that makes it happen. So highly profitable, really not, I mean, Visa is there, but they're a weaker competitor in the technology side. So to us, it remains a company that will be very profitable no matter what for a number of years. AutoZone, again, I just mentioned, great business, really not sexy at all. It's just car parts, but no one can replicate what they do. So at the end of the day, they have highly big profit margins, high return on invested capital, but no one can really restart a distribution business of car parts throughout North America and try to compete with AutoZone. So it's their business at this point, and they can keep compounding for a long period of time. And Microsoft, I don't have to tell you, they own the corporate relationship, through the Windows, through the Excels, the PowerPoint, and now the Teams environment, and now with Copilot, with AI. Again, AI will have great functions that we'll all use one day, but what you need to have these functions happen is you need data. Because an AI model without data can't do anything. And who has all the data for most corporations in the world? Microsoft. It's either on their cloud, on a PowerPoint, on an Excel, on a Word spreadsheet. So they have kind of the leg up to be able to integrate AI, we think, within the suite. But no matter what, if AI isn't what it's supposed to be, Microsoft is unmovable in terms of their entrenchment in corporate, I would say corporate America, but corporate globally. A couple of additions in the portfolio. We added Novo Nordisk in the year. Novo is the GLP-1 Ozempic Wegovy company. To us, it's just the beginning. When we look at the next 15 to 20 years, those obesity drugs are just going to be more and more prevalent. They're probably going to come in pill form. And at this point, there's Novo Nordisk and Eli Lilly that are the two leaders and are opening a wide gap in terms of having the best molecules to service that. But why we really like Novo is, on top of that, they have this great insulin business that is not going away. They've had it forever. They're one of two manufacturers that can make insulin at scale. And so this is a very stable, great business. So we have the part that's a little bit more growthy with the GLP-1s, the weight loss drugs. But on top of that, we have this great, stable insulin business. And we think both together are making it a great pharmaceutical name to own in the portfolio.
Thanks very much, Guillaume. That was super informative. So I think we're going to we've got time for maybe a couple of questions, and then we'll just take a wrap up for a second or two from each of you. So one question here that we've had, I've had it in a couple of different ways. It's on tariffs. So from your portfolio, how well would you say is it positioned to either pass on those higher costs to consumers or avoid tariffs altogether? So could you give perhaps some perspective on that?
Very good questions. So tariffs, and Dave was highlighting, will he, won't he, how will he, so it's very, very dangerous to trade on tariffs. We would never do that. But if you hear people to have an edge on what Trump's going to do, I think is as crazy as what Trump's going to do at this point. We've looked at all of our companies. No company has like a business model that would be impaired in case of tariffs. So we sleep very well at night. All of our companies are fine. When you look at tariffs, there's a few points to look at. Number one, it's not where you're located, it's where you're producing. That's really important. So, for example, a Nestle, that's a global conglomerate. We have a lot of these global conglomerates. They make things in the US. So they can make all of the dog food for Purina is made in the US. So the impacts on tariffs is going to be way less for them than, let's say, a Ford or a Chrysler, like a US auto company that's importing steel and aluminum and half the car parts in the US. That's an American company, but they're in trouble with tariffs because they're going to have to bring up the price of their cars significantly. While those multinationals, it all depends where you're making the things and if you're being impacted by the flow of tariffs. That's number one. Number two, where you can really lose on tariffs is if you have competition locally that can take share. So think about lumber for Canada, think about steel, think about a lot of manufacturing companies close to the border that might have something in the US that can really quickly take the share that you lose. So if you raise your price, you price yourself out of the market. We don't have these companies in the portfolio, but we have companies like, for example, a Carrier that makes HVAC or heat pumps. They make everything in Mexico. So we talked to them. We're like, what are you going to do if the 25%? They said, well, we're going to have to raise our price 25%. There's really no ways about it. But they said, everyone's here with us. There is no more manufacturing of HVAC systems in the US. Hasn't been for decades, because if you did that, you would have been priced out of the market the last 20 years. So everyone came with us to Mexico. So everyone's going to have to raise pricing. American consumers will have to eat that price increase. So if there's not idle capacity in the States, it's just a price increase to the American consumer. And number three, just a quick reminder that Trump always said that the tariffs were supposed to pay for a tax cut. So we've yet to see the tax cut announcement, but that could offset as well some issues with demands or recession, because just putting tariffs, it's just going to bring inflation in the US. And Trump always said he beat Biden because Biden got everything to get more expensive. So at this point, he's doing the tariffs to pay for a tax cut. So we have to see what the tax cut is gonna do. But the companies are fine, and we don't want to say this too loud, but having highly profitable, like you saw, double the index, low leverage company with great management, with massive, like you saw, like business models that are like duopolies or monopolies or best in class. Well, it tends to lead to, when things are tough, these companies tend to do better. Maybe not in absolute, like we always love, but in relative, and that's tough relative, but sometimes in relative, when things get tough, it's the company that's more profitable, that has more lever to pull, that has the better management, that has low debt, that can invest, that can do better. And we've saw that in the last few years. An example I can give you is Sherwin-Williams in paint. It's been a tough 2-3 years in paint, facing increasing interest rates in the US and the slowdown that it brought in terms of construction. But Sherwin has been taking a massive amount of share from PPG throughout the last 3 years. You talk to management, they are very excited about what's happening there. And so market is tough. You don't really see it in the absolute results of Sherwin, but when you go talk to them, they're very giddy about the economy rebounding. because they were able to take a lot of share in the downtime. So if it gets tougher because of tariffs, our companies should be able to do better. But nobody is really in absolute. It's going to be a headwind, but all of our companies are well positioned for it, and no business model is anywhere close to being impaired or in having any issues with significant issues with tariffs.
Thanks very much. Now we're almost out of time, Dave, but we just heard from Guillaume there. Is if you had 60 to 90 seconds to sort of wrap up as you look into 2025, what advice would you give to clients and advisors?
Well, first and foremost is you do need to be diversified. You need to be diversified geographically. You need to be diversified across investment styles. So a nice blend between growth and value. You need to be diversified geographically. You need to be diversified across asset classes. So healthy exposure to fixed income and equities. And if you have that and you have good, strong management teams, as we're seeing from PineStone, here in your portfolios, you're going to naturally have really strong, high quality portfolios, which would then result in the level of portfolio resiliency, meaning that the portfolios will be well suited to a wider range of outcomes. So we can rest easier at night knowing that we're well diversified. We've got great management teams behind us. And if you're focusing on those types of managers, you're going to do well over the long term across most market environments. And focusing on that, it's all good.
Well, thanks very much, Guillaume and Dave, for joining us today. Super appreciate it. So I'd like to thank them for joining, and for all of you for joining as well. Thank you very much, and have a great day.